Good afternoon. This is James Perry at Perry Capital in Miami. It's Friday, September 12th. U.S. stocks continue to make record highs. U.S. bond portfolios are posting very strong returns, mostly on tighter spreads. Gold and crypto have had great runs. Small caps and even these meme stocks are attracting huge inflows. Even small retail investors are making big money. So risk assets are rallying and are expected to continue to do so into the year end and into 2026 for many small reasons and one very big one. The big one is that the Fed and global central banks in general, plus all the treasury authorities worldwide, continue to provide extraordinary accommodative monetary and fiscal stimulus. Global money supply is up almost 10% this year to $140 trillion. Pre-pandemic, it was 70. Yes, it's doubled. And in fact, half of that global money supply is Chinese. Claims that the Fed is restrictive. This is completely inconsistent with the massive liquidity in the financial system and the broader economy. Monetary and fiscal stimulus is designed in the U.S. and abroad to increase debt burdens in an attempt to achieve better present economic growth objectives. It's that simple. And slow growth economies, which is most of them, this is keeping governments in power. And in expanding economies like the U.S., liquidity is providing a tremendous tailwind for risk assets. So central bankers are doing what they always do, inflate for the benefit of asset owners and at the expense of the middle class. Okay, so it's a big week next week for the Fed. They meet on Wednesday. They will cut rates. Despite the fact that inflation is rising, they are going to lean toward what they perceive to be as a weakening labor market. I'm not so sure. With respect to inflation, core CPI, last report, up 3.1% over the last 12 months. Core PPI up 2.8% over the last 12 months. And the Fed's preferred measure of inflation, the personal consumption expenditures number, it's preferred because it's the lowest, is up at 2.6%, up from 1.5% 2 years ago. So inflation is rising, and the reason it's rising is because of deficit spending. And people have to remember that government spending has increased by 75% over the last 4 years, from 4 trillion to 7 trillion. And it's being supported, of course, by QE. The Fed's balance sheet has doubled from 4 trillion to 7 trillion, or almost 8. The trade deficit has doubled from 600 billion to 1.2 trillion. The budget deficit has quadrupled, right, from 500 billion to 2. And this is why you have in-service inflation. This is not tariffs. This is not imported goods. China and India are exporting deflation. Chinese factory gate prices have fallen 36 months in a row. China is deflating. Indian prices are falling too because they've got to offset higher service tariffs. So this is a real problem, right? Money supply is the biggest issue. We've gone from 11 trillion in 2019 to 30. And national debt, as you know, was about 22 trillion pre-pandemic, and now it's 38. So we've got to cut spending. That's the simple matter. But the point is, the Fed is going to let inflation run because they are worried about being criticized for throwing the economy into a recession. And remember, Powell is a lawyer. He's not an economist. He is a politician. The Fed is very political. It will continue to be political. Look at this little graph here. This shows you the Fed, bullish and bearish, hawkish and dovish. You know, it depends on where you're from, but there's a lot of people that think modern monetary theory is a good idea, and they're on the Fed, so it's political, believe me. It's also going to remain independent, so don't worry about that. Most of this stuff with Fed, Chairman Powell and the president, it's just a bunch of noise. I think it's irrelevant to the market, quite honestly. Anyway, watch for the Fed on Wednesday. That's a big moment. Perry Capital is forecasting a stronger economy than most expect. The Atlanta Fed slates Q3 GDP at 3.1% at the moment. I suspect it goes higher. GDP is supported by robust corporate profitability. Don't know if you saw all the numbers for Q2 earnings reports out of the S&P 500, but top line revenues across the board up 7%. That's close to a record high, and certainly the highest it's been since 22 when we had all that stimulus. And at the bottom line, profitability, earnings were up 12%. These are two numbers that are bigger than Q1, which were also outstanding. And I expect that current corporate earnings will be just as powerful in Q3. Why? Pretty simple, man. Lower taxes, deregulation, reduced government spending, lower trade deficit, and enhanced national security. I really do believe, and many people argue with me on this, but I think the world's a safer place. The Middle East is stabilizing. Putin's going to have a choice to make pretty soon here because more sanctions are coming. And I think China's going to have to cool its heels a little bit too because they're slowing down so much that they're going to have to play ball with the global economy. Otherwise, they're going to get shut out of it. And no, I do not think they're going to invade Taiwan. It would be the stupidest thing the Communist Party could ever do if they want to stay in power. So corporate profitability is good. The problem is that the younger cohort of voters who are growing stronger and stronger and more conservative as we go, thanks to people like Charlie Kirk, they are locked out of the housing market. They can't afford to get that first house, and they don't have assets, and they're not offsetting inflation. So their disposable income numbers are really hurting, and most of the middle classes too, and small businesses. So that's a problem. I wish the Fed would try to fight inflation. That's the only thing that's going to really help this group. Rates are falling. Mortgage rates are falling. They're down below 6.5% now. I think they will fall further, and I think the realization is that the global economy is deflating, except for here and the UK, I suppose. But that's debt and deficits, which is being addressed in this country, and it's not in the UK. So I think we're going to be in better shape. Dollar's okay. Again, business development and business investment and cash flows into this country are keeping the dollar still in bullish territory, although it had a rough year, down 13%. But I do think that interest rate differentials will support a strong dollar at these levels. I think slower inflation is coming. That's what the bond market sees. I believe that's right. But again, service sector inflation for the middle class is really hurting everybody. So stay long the high-tech stock area. The Mag 7 continues to pace the market. I think the Mag 7 was up 5% in the last week. So the big hyperscalers continue to gain market share. They will continue to do that. Industrialization in this country is coming. It's coming quickly. I think that's going to be a good place to be. And energy. I think nuclear energy is going to come. And it's here now. We just got to get the deregulations out of the way and get this stuff going. So I'm optimistic about the economy, and I'm pleased with the Perry Capital portfolio. We're well positioned. I hope most investors see that. My clients certainly do, and they're very happy, and I think they will continue to be. We're not going to change the portfolio much. A little tweaking here and there. I'll let you know. Good luck. Have a good week. I will talk to you after the Fed next week. Thank you. Bye.